Good afternoon, and thank you for joining us for this installment of EPIC Insight. This is Chris Colangelo, Senior Marketing and Communications Consultant here at EPIC Retirement Plan Services, and I'll be your host for today's call. We're excited to be joined today by our very own Paul Oakford to give you an overview of our new 401k-inspired HSA solution, MyHSA. While it's new to the EPIC RPS family with our acquisition of ABG Retirement Plan Services in April, our MyHSA team has been offering HSA services for over 15 years. We're excited to be able to bring this solution to the table for you and your clients. Paul Oakford is the Senior Manager of HSA Services for EPIC Retirement Plan Services. And in this role, Mr. Oakford leads the team in all aspects of health savings accounts, including program development, client relations, administration, web experience, and employer and employee HSA education. Just a quick reminder, your line will remain muted throughout the call. But if you have any questions you would like to ask, please enter them into the GoToWebinar panel, and we will address them at the end. And with that, I'll turn it over to Paul.
Thank you, Chris. I want to thank everybody for taking time out of their busy schedule to join this webcast. I look forward to showing you our about HSAs and our program and answering whatever questions that you might have. So with that, let's get going. Just briefly, for those of you who may not be familiar with EPIC Retirement Plan Services, our core business is employer-sponsored retirement plan record keeping, and we also have an HSA solution, obviously, which what I'm here to talk to you about. But in all of those plans, we have about over 5,100 plans. We're in all 50 states. We do the record keeping on more than 280,000 participants with over $21 billion in defined contribution assets. So we've got a lot of experience in this, and hopefully you will see the real advantages of our program when we get to that. But first, I wanted to start out with a little information on what HSAs are and answer some more common questions that tend to come up and employers tend to ask about. So kind of give you some information for when you have those conversations. But HSAs were first created in December of 2003 as part of the Medicare Modernization Prescription Drug Act, signed into law by then President George W. Bush. An HSA is an individually owned account. It cannot be a joint account. So there's just one owner to that account. HSAs are also not employer-sponsored plans. So they are not meant to be subject to ERISA, which is a great thing from an employer standpoint. HSAs are also not a use it or lose it type of an account. They're actually a use it or keep it. So what you don't spend by the end of the year rolls over year after year, and hopefully by the time you get into retirement, you've got this nice account balance that you take into retirement with you to help pay for your qualified retiree medical expenses. And because it's not an employer-sponsored plan, and they are individually owned accounts, HSA accounts travel with employees. So if they terminate or retire, move on to another employer, they take those accounts with them to where they go. Here is the great thing about HSAs: triple tax savings. The money that you contribute to your HSA goes in tax-free. The earnings on that HSA grow tax-free. And no matter what the account holder's age, if they take money out for qualified medical expenses, that money comes out tax-free. So when you combine the triple tax savings with the no use it or lose it, you really have the best, and HSA provides the best tax savings vehicle on the market. And it really needs to be incorporated in the employee's retirement plan strategy. So let's talk about eligibility. what are the criteria for someone to be eligible to open an HSA and also contribute to that HSA? First, they must be enrolled in an HSA qualified insurance plan. Second, they cannot be enrolled in any other non-qualified insurance. And you might be asking, what are examples of non-qualified insurance? First would be enrollment in a full benefit medical FSA or flexible spending account. Second would be typically most employer health reimbursement arrangements or HRAs are probably going to be disqualifying. And then obviously number three would be if you're enrolled in your spouse's low deductible health insurance option along with your employer's HSA qualified health insurance option. Those are all examples of non-qualifying insurance. Third, you cannot be enrolled in Medicare. So once you sign up for Medicare Part A, you cease to be HSA eligible to contribute to an HSA any longer. And then lastly, you cannot be claimed as a dependent on anyone else's tax return. Now we're going to move into contributions. So the IRS sets these limits every year, and they kind of break it up into individual versus family. And the way they determine that is if you are covered on your HSA qualified health insurance as just you, so that insurance just covers you, you have individual coverage. If that HSA qualified health insurance covers you plus one or more members of your family, then you are considered to have family coverage. In 2020, the individual maximum contribution is $3,550. In 2021, that jumps up to $3,600. For family, 2020 max contribution is $7,100, and in 2021, that jumps up to $7,200. Now, for the catch-up contribution, it doesn't matter if you have individual or family coverage, but if you are 55 or older at any time during that tax year, you can put in an additional $1,000 catch-up contribution. Now, people who enroll after January 1st are considered a mid-year eligibility, and their contribution they need to really think about how they want to do their contribution. Obviously, if somebody becomes eligible January 1st and they remain eligible through the end of the year, they can put in the max contribution and not have any issues whatsoever. But if they come in any time after January 1st, they have to make one of two choices. They can prorate their contribution, so they take the max amount they can put in, divide that by 12, and then multiply that by the number of months that they were eligible on the first of any given month, and that would be how they calculate their prorated contribution. Now, the IRS came out several years ago and said, well, we want to make it so that somebody who comes in mid-year, as long as they are enrolled and eligible by December 1st, that they can put in the max contribution. So if I'm enrolled by December 1st, I don't have to prorate my max contribution. I can put in the full amount, but if I do that, I'll be subject to a testing period. And that testing period says I will remain HSA qualified all 12 months of the following tax year. So I could become eligible December 1st, put the max in for the current year, and then January 1, turn around and put the max contribution in for that next year. But I have to remain HSA qualified for all 12 months of that year. If the employer is going to make contributions, they have to follow the comparability rule. And what the comparability rule basically says is what you give one employee in one category, you must give all employees who are in that same category. So the employer can break their employees up into different categories. for example, full-time versus part-time. They don't have to give part-time employees the same amount they're giving full-time, or they can break it up by the HSA qualified health insurance coverage. So individual plus one, individual plus two, and individual plus three or more. So they've got different flexibility on what they want to do there. But however they do it, what they give one employee in one category, they must give all employees who meet that same definition of that category. Another question a lot of employers ask is, well, when I'm sending in employee payroll deduction, are those pre-tax or are they after tax? Well, if you remember, I said all contributions go in tax-free. And that's true, but a lot of employers think that that's how they send in employee payroll deducted contributions. And really, the only way the IRS will allow that to be done is to add the HSA to the employer's cafeteria plan document. Now, if they add that, there are additional advantages. One, the employer and the employee save the additional 7.65% FICA Med-FICA tax. And on the previous slide, I just told you they have to follow the comparability rule. Well, if they add the HSA to a cafeteria plan, that comparability rule doesn't apply anymore. So they've got a lot more flexibility in how they want to make their employer contributions. For example, they could do a matching contribution to the employee's HSAs if they run this through a cafeteria plan. Now, they still have to be careful because all contributions will be included in the cafeteria plan non-discrimination testing. So they don't want to favor highly compensated employees or key employees. Otherwise, they're going to fail their testing and then have issues. So in general, I think the safest way is to just come up with a comparability rule, say anybody who has this type of coverage is going to get this, and anybody who has that is going to get a different. What we see most commonly is individual and family is how most employers break it up. But again, through a cafeteria plan, they have some more flexibility with that. If they don't add the HSA to the cafeteria plan, then all employee payroll deducted contributions are actually taken out of the employee's checks after tax. That doesn't mean the employee is going to lose the tax advantage. That just means they will take an above the line deduction from their gross income when they file for any money they had payroll deducted to go into their HSA when they file their personal income taxes. So they get the tax benefits. They just get it later when they do their personal taxes as opposed to the point of payroll deduction. However, they do not get that FICA Med-FICA tax savings if they run it post-tax. So, and as always with the post-tax contributions, that comparability rule always will apply. Another way to get money into an HSA is to do, the IRS will allow a once-in-a-lifetime rollover from an IRA to an HSA. That doesn't mean that, hey, if I've got $100,000 sitting in an IRA, I can roll that all into a traditional IRA, I can roll that all into an HSA. Unfortunately, you are limited to the maximum contribution that you are eligible to contribute for that year. And if you, let's say this year, someone with family coverage who's over 55 could put in a maximum of $8,100. If they rolled all $8,100 from an IRA into an HSA, they could not contribute any additional dollars to their HSA, and that includes employer money as well. So they just want to keep that in mind when they're determining how much they want to roll, and they can only do this once. And then there's also a testing period that the participant must remain HSA qualified for 12 months after they do that rollover. Distributions from an HSA. Well, the account holder can not only use their HSA money for their own qualified medical expenses tax-free, but they can also use it for their spouse and any qualified dependents qualified medical expenses, all tax-free. And guess what? The spouse and the dependents do not have to be HSA qualified in order to get their expenses reimbursed. So if only the account holder is, or maybe the account holder isn't qualified as well, they can still use that money on whatever qualified medical expenses that they incur. HSA dollars, they don't always have to be used for qualified medical expenses. That's another real advantage to an HSA, and I think it also helps play into the retirement strategy of using an HSA when you are older and in retirement as well. If someone takes money out for, say, a big screen TV, if they are under the age of 65, they're going to pay ordinary income tax on that distribution plus a 20% tax penalty. Once they turn 65 or older, they could take money out for a big screen or big screen TV or a non-qualified distribution, and all they're going to pay is ordinary income tax. At that point, that 20% tax penalty goes away. So really, for non-qualified distributions, when you're 65 or older, your HSA is going to work a lot like a traditional IRA distribution. So again, it just gives them more flexibility on how they're going to use their HSA in retirement. But remember, qualified medical expenses are always tax-free. And a neat thing, distributions for qualified medical expenses do not have to be reimbursed in the same tax year that the expense occurred. So if the account holder has the financial ability to pay for their qualified medical expenses with after-tax dollars, so they're not touching their HSA, they can shoebox all those receipts 10, 15, 20 years down the road, pull that shoebox out, add up all those receipts, and take a tax-free distribution later in life for anything they've never reimbursed themselves for. By doing that, they're maximizing the growth of their HSA by dipping into it as little as possible over the years. And then with an HSA, there is no required minimum distribution age to start taking money out. So nobody's going to tell you that by the time you turn X years old, you have to start taking money out. It's another real advantage to the HSA. Now, I want to get into some industry level numbers for you, and I hope that by looking at these, you're going to see some real opportunities for you by talking about HSAs. There's a company out there, Devonair Research, and they do a mid-year and a year-end study every year on the HSA marketplace. And the next several slides are going to come from the 2020 mid-year report that they released in July. From what they found at the end of June, they estimate there is over 29 million HSA accounts out there. So what I think that tells me is a lot of the clients that you're already talking to or that you want to talk to probably have an HSA qualified health insurance plan in place for their employees, and their employees are probably putting money into HSA accounts right now. Out of those 29 plus million accounts, there is over $73 billion sitting in HSA assets. And if you look over to the right on your screen, Devonair estimates by 2022, that number is going to jump to almost $105 billion in HSA assets. So these continue to grow and will continue to be a big opportunity. And here's a number that came from the report that I find a little hard to believe, but there is only, out of that $73 billion, only $17 billion of that is actually in investments. So where's the rest of the money? Well, $56 billion in HSA assets are sitting in bank checking accounts, earning low bank interest rates. I think that is a huge opportunity for advisors to go in and educate employers on these types of programs and show them different opportunities that they have. So a couple more things. There's only about 1.5 million HSA accounts out there that are actually investing. So that means there's 27.5 million accounts out there that have their money sitting in a checking account. Contributions continue to rise in these accounts. As of the first half of this year, there was almost $24 billion contributed to HSA accounts. So we've talked about what HSAs are, some information on contributions. We've talked about the industry, and hopefully they're showing you some opportunities for you. Now let's talk about the typical HSA solutions that are available in the marketplace. And this structure that I'm going to talk to you about now is really about what 95 to 99% of HSA administrators use. So they're all using the same basic structure. And they all start out with a basic checking account. All contributions and all distributions are going to flow through this checking account. And the money in there is only going to earn a low basic checking account interest rate. That checking account is going to come with a debit card. And on that debit card, you're only going to have access to the funds in that checking account. Now, many HSA administrators also offer investments, but those investments are going to be in a completely separate brokerage account. In most cases, if the account holder wants to invest, they have to funnel money from that checking account into that brokerage account. And if they need access to the money in that brokerage account, they have to go in, select which funds to sell off, and then they have to transfer that money back to that checking account in order to get access to it. I think it's a process that requires additional work, and I think it intimidates a lot of account holders. And to me, that explains why we've got 27.5 million accounts out there that aren't taking advantage of investing. And then, in addition to that, I think these have very low account balances because people are keeping their money in a checking account and they're thinking, well, why do I want to keep thousands of dollars in this checking account earning basically nothing? So employees are using these as a short-term spending vehicle as opposed to the long-term health savings account that they really are meant to be. So employers and employees need your help. Obviously, $56 billion sitting in a checking account in checking accounts isn't a great scenario. The primary resource when employers ask for education, their primary resource that they go to is the health insurance agent. And the health insurance agents are fantastic. They're fantastic at explaining the benefits of the health insurance. But when it comes to the actual health savings accounts, most of them, there's some that do a really good job there too, but most of them, when asked, they tell the employer, well, why don't you check with your bank that you do your corporate banking with, because they probably have a solution and you could probably use them. Or they're going to tell them, well, why don't you look at the administrator that the health insurance may have partnered with. And that's about it. So if employers don't understand these, how can they educate the employees? Advisors are the perfect people to go in and have those conversations and really educate both the employers and the employees. And I think by doing that, you're going to open up a lot of opportunities for both HSAs and I think new 401k plans as well. Now we're going to talk about our MyHSA solution powered by EPIC. And what we have put together really is a true 401k inspired HSA. With our MyHSA, our account holders really only have one account that holds both cash and investments. There's a very low cash threshold. As a matter of fact, the most cash that a MyHSA account holder can actually have in their account is only $200. Once they have contributed above that $200 cash threshold, their money is automatically invested. And then we also understand that our account holders are going to need access to their invested balances to pay for qualified medical expenses. So what we've done is we give them access to between 95% and 100% of their total account balance on that debit card. So what they do, they go to the doctor, they give the doctor their debit card, that claim comes back to us electronically, and if that claim is for less than what the account holder has in cash, we will pull from cash to pay that claim out, and we won't even touch the account holder's investments. If that claim comes to us and it is for more than what the account holder has in cash in their account, our system will trigger an automatic liquidation of investments using a pro rata formula based off of the percentages held within each investment. And we will first liquidate enough to pay that claim out. And then second, if needed, we'll liquidate additional dollars to get the cash threshold back up to $200. And the reason why we do that second liquidation is when needed, we hopefully we're getting smaller claims over time, and we're pulling more from cash than we are from investments. And thereby, because of that, hopefully we're maximizing the growth of the account and really giving the account holder the best maximization that we can. We also offer additional online tools for our account holder. Obviously, there's some in there to help them do research on investment options. We have other online tools available to help them do research on doctors and medical facilities and things like that. Just tools that will allow them to get the most benefit out of their MyHSA account. And then lastly, one real neat thing and unique thing that EPIC offers with our HSA solution that not many HSA administrators can offer is if you have partnered with EPIC to do the record keeping on the employer-sponsored retirement plan and the HSA, then those employees only have to log into one account to view both their 401k and their HSA. That really is a unique benefit that you can get by working with EPIC as opposed to most other HSA administrators. Now, as I said, I think the structure of ours with automatic investing, easy access to invested money on a debit card really promotes long-term saving. If you look at the Devonair report and do the math, the average account balance nationwide is about $2,500. Our average account balance is over $12,600. Now, I think that's because people, when they have their money in investments as opposed to a checking account, they view their account differently and they tend to use it for what it really is meant to be, a long-term savings vehicle. Now, in our retail solution, we have risk-based asset allocation portfolios, we have target date funds, we have a fund menu of about 20 to 21 funds available that they could do a customized election in. And one of those funds is a MetLife guaranteed account, which is also our default account. And that fund is currently paying an interest rate of 0.57%. So you as an advisor might say, well, I really like this platform. It's unique. It's different. I like how it's promoting savings. And you could provide our HSA resource to your clients And there is a monthly compensation for you for the accounts that you bring in. So that's one option. The second option is our advisor MyHSA solution. You're going to be on the exact same platform. So one account, automatic investing, access to invested dollars on the debit card. But in our advisor solution, the advisor signs off as the investment manager. And the advisor then becomes responsible for the investment options, portfolios if you desire to have those. And because of that, you then can charge an asset-based fee for all of the clients that are on your program. And you'll create one program and you'll market that program to all of your clients. So it's easy. You're only administering one fund lineup, but you have the ability to charge an asset-based fee. And then we can also offer branded web and marketing materials if that's what you want, or we have generic MyHSA materials that you can use as well. And again, I think I really encourage you to incorporate HSAs into your conversation with prospective employers. As you all getting in front of an employer to talk about 401k plans is not always the easiest thing to do. But if you can incorporate HSAs into that conversation, just know that there are very few people out there actually having that conversation with employers. And I think it's, as I said, not only going to open up doors for you on the HSA, but I think it's going to open up opportunities for you on retirement plans as well. That's my presentation. I hope you found it beneficial. If you've got any questions, please let me know.
Okay, thank you very much, Paul. As Paul mentioned, we'll open up the floor for a few minutes of questions. If you have anything you'd like to run by us, go ahead and put a question in the panel right now. We'll start with one. If a client is currently using EPIC RPS for their retirement plan, can they upload the HSA contributions on the same payroll file as 401k?
At this point, no. They would be two separate files, but that would be something that we would like to look at as an enhancement down the road.
Okay. So far, that's the only question we've had come in. If anybody thinks of any questions that they would like to ask, feel free at any time to reach out to your sales consultant or your relationship team, or you can enter it into the survey that shows up at the end of the session. And with that, thank Paul again, and thank you all for joining us for this EPIC Insight webinar. As a reminder, we'll be sending out a copy of today's slides along with a link to a recording of the session in a follow-up, so you can check it out then. And we appreciate your partnership and wish you and your families well. So, thank you, everyone.
Thank you.